Every trader wants to know where the market will move next. And most importantly, everyone wants to enter the market in such a way that you do not get hit by a stop and the price immediately moves in the direction of your trade. When you can determine the next more likely direction of price movement, the entry point is the easiest part of the trading process. The hardest part is figuring out where the price will move next, and most importantly, how. Everyone uses a different set of technical analysis tools. Some people draw trend lines, some use averages, some mark high and low. This all works, but there is a better and more detailed approach, which will not only indicate exactly where the price will move next, but will also allow you to find accurate trades that will carry a huge profit. And now I'm talking about order flow. This is essentially the structure of price. It's tiny building blocks. It's just that nobody pays attention to this structure, and most people just don't have the vision to perceive these patterns. But in this video, I will fully disclose the theoretical and practical component of this issue. In this video, you will learn how to determine the market structure, how to determine the next impulsive movement within the day, how to find the exact entry point in this movement, which will not take a stop. What order flow is, what elements it consists of, on what time frame to watch it, how to enter the market so that your deal immediately flew into profit, how to understand that your hypothesis is correct and you are moving with the market, how to understand that you are moving against the market and need to close the deal, how to re-enter in the right direction and cover the loss. The video will be very dense and intense, and most importantly, at the end of this video, I will give you ready working setups that you can use immediately after watching this video. Now let's get to the main part. So friends, let's talk to you about the basic elements that make up any market movement. If you can perceive the market in the way I am about to show you, then any movement will acquire a certain meaning, a certain logic, and a certain sequence. If you understand which of the stages is forming on the market now, you will choose a more suitable strategy or entry point, and you will either, for example, decide to trade only one or the other, and it will help you to bring your trading to a new level. That is, there is a certain movement in the usual classification. That is, people have a trend up, then a trend down, then consolidation. But in all this movement, there are smaller structures. This is not order flow. We will talk about it now, but you should see how the price is formed. And it is formed in the following way. That is, I distinguish only 4 types of market movements. That is consolidation, impulse, correction, and reversal. That is, everything starts in principle with consolidation. Usually consolidation is a price movement in some narrow range. If you can observe, here the price moves sideways in consolidation. That is, if impulse movements are always either up or down, consolidation always goes sideways. And if you look like this, yes, you pay attention there, maybe to order blocks, to grapes. Yes, it is all necessary and useful. But there are other additional slices and layers of information which help you to understand in more detail what you see in front of you. And that's very important. The more information you have, the more you're aware of what's going on, what you see in front of you. The more balanced and qualitative decisions you can make in order to earn a systematic and confident profit. And most importantly, informed. That is, when you realize that now there was such a movement, here I am going to enter so-and-so. That is, you do the action according to a certain algorithm. Most traders act chaotically. I want to enter here. I want to exit there. That is, they have some definite ideas in their work, but most of them trade haphazardly and chaotically. And if you start to see the market in the following way, you will have a clearer picture of what is happening, using the most basic element. So here we have consolidation. Usually, consolidation ends with the formation of an impulsive movement, which breaks through this consolidation. That is, here we had this candle, which broke through the consolidation, and the next candle after it tested this consolidation and went somewhere higher. If you can notice and distinguish these elements, you would have clearly missed this movement because you realize that this is consolidation. And consolidation movements are not always poor. in the sense that the price moves very slowly, with very low volatility, which means, let's say the risk doesn't pay off. That is cool when you have determined the direction of movement, entered, the price gave a reaction from your entry point and flew somewhere. Everything is cool. That is, you have risked some amount of money, and you have as if the reward for this risk is much, much more than when you trade something during consolidation. That is usually due to the fact that traders do not notice that volatility has fallen and the consolidation period has started. They continue to fluff the market and try to somehow squeeze the maximum out of it, although the market does not give these opportunities. And due to this, many people make mistakes, start to freak out. That is, such basic things. And here, for example, is the situation. That is, we have something similar to a block order. And here you, for example, notice it. Sit down in the morning, notice it. The price comes to it nicely and seems to give even a movement. You are happy. And then you are taken out by stop loss. All because you tried to enter during consolidation and did not wait for the exit from this consolidation. That is, you, in the middle of consolidation, were already sure that one order block will send the price down. It doesn't work like that. That is, if you are guided only by such random things, you will make a lot of mistakes. Context must come first. If this context is supported by gaps or order block or their breaker, well, some other elements, then everything works clearly. If you just chaotically shove these smart money elements everywhere, then everything will work against you, and you will only freak out and get angry. At this moment, even if there was no order block or something like that here, it was possible to enter the market more or less qualitatively. So what is the logic here? We realized that there was consolidation, and then the impulse movement started. For example, you entered here, or you missed this impulse movement, and after the impulse movement there is usually always a pullback. That is, it happens very rarely when the price just goes straight into a certain direction. It is either on the news, well, in short, these are not tradable areas. It is impossible to build any serious systemic result on them. That is, usually it is always accompanied by corrections. That is, impulse, pullback, impulse, pullback. And what is the big problem of most traders? That is, the majority of traders take these correctional areas as a call to short. That is, they play more of a psychological aspect. That is, they miss this movement. They have a picture in their head. Wow, the price went up here. If I enter here and the price falls at least here, that's how much I will earn. That is, he initially applies the wrong logic. And look, there is also an order block. Yes, there is also a gap. It seems that everything corresponds to the parameters, but the initial movement is chosen incorrectly. That is, we have an ascending structure here, and we are moving with it. We're going to talk about the structure in the video today, and hopefully, at the end of the video, all these answers will be clear to you. But the logic is such that most traders miss the most obvious thing and try to enter against the market. Well, I mean, it is a mistake. I don't know. 100% of traders, everyone tries to short a rising market or buy back a falling market. The logic of smart money of this minority is that they look where the price is going, either to liquidity or to gap. We will talk about it. But while we are interested in the structure of the market, this movement was impulsive. Then it was corrective, and you just need to break yourself to the point where you stop perceiving these movements as a call for a reversal. That is, there is no such regularity. If the price has grown, it should immediately fall. No, it doesn't. No, the price is constantly moving somewhere, and you need to move with it. And when you apply even this elementary basic logic, you mark 3 squares. Although I do not do this, but I already perceive it on a subconscious level. But you, if there is new information for you, if you have not sharpened your vision yet, you can simply mark it out. As you go along, aha, this was consolidation. That was the momentum. That is, it ended here, but most likely, this is a correction. What after the correction? If there are still some targets above, then most likely there will be an impulse. If you go into this whole story on the lower time frames, We will talk about it in more detail today. And all this movement was impulsive and corrective. That is, all this movement was accompanied by impulse correction, impulse correction, impulse correction. Here, in principle, it was possible to find a lot of entry points. That is, in principle, different from the fact that there was an impulse, there was a pullback. And most of them are somehow, well, like, I do not know how all this has been used, yes, in such a primitive format, but the majority of traders trade in this way. That is, they notice this whole structure as just one upward movement. Then there was one pullback down, and then there will be something further. And in this whole movement, there were still very small movements. But again, it is not order flow. It is just the components of any market movement. After the impulse, we usually have consolidation, and it happens when the price reaches some important level, or liquidity withdrawal, or overlapping of the gap. So there is a very high probability that we will have consolidation. And again, most traders who miss this will try to go short, here, there, somewhere to look for some points, not understanding the logic behind it. And again, as I said, in consolidation, it is foolish to find an entry point with the expectation that it will lead you somewhere. That is, you need to look at the exit from consolidation. And then, for example, this point, yes, you have assumed that this is the red wave, this is our reversal. So there is some level of liquidity here. We have taken it off, and it is potentially possible to go lower somewhere, to cover the gap or this block, which is at 30 minutes. And you would make money on that move. So you wouldn't be trying to buy here. You would not try to buy here. You would short it. That is, well, as a typical trader does. Again, he shorted. Here he gets a minus. Then, all right, understood. The movement down, that here he still hesitated. And then he starts to buy further. Well, that is, in short, it works exactly the opposite. And when you have in your head an idea of how it all forms, even just on such elementary things, then you will be able to make more informed decisions. And again, the important point is that there does not have to be a reversal movement after such consolidation. It could be just some manipulation and upward movement again. It all depends on the situation, on the target, on what liquidity was taken off. I will talk about all this in the next video, where I will tell you step by step how to collect all this in real time, how to conduct such an analysis, so that you have all these elements not just in theory, but in a specific, applicable daily frame. So friends, now let's get a little bit ahead of ourselves. To the point and to the question of how to realize that this will be a correction, that after it there could potentially be an impulsive movement, you need to be guided by the following element in all of this. That is, if you're waiting for some impulsive movement, you do not know that it has been formed yet. But if there is a goal for this impulse movement, for example, it is just this liquidity. So this impulse, it has not yet removed this liquidity. And in principle, it is logical to assume that if there is an upward movement, it will be at least behind this liquidity, and there are still some certain targets. So if there are still targets in the form of liquidity or gap, then you count on the fact that the impulse movement will be in that direction. Now, the most important thing about the correction, for example, you do not know yet that a correction is forming. But there are two elements of smart money here. Here we have the first gap that does not hold. That is, something price consolidates, and fails. And the second gap, and here on this gap, the price finds some support. There's also a block below, but the price does not come to it. That is, you understand that at a certain time, at the beginning of a volatile session, the price withstands this element. That is, our gap is not broken, but on the contrary, the price shadows here. But the bodies are inside, and there is a certain support here. That is, at this moment, you realize that the price supports the idea of upward movement. And just here you are already forming your hypothesis. Well, it can be minimal, for example, M15, but you enter there, for example, at M5, and here you could easily take 3, 4, 5 X's. The logic is that there is something that prevents the price from going lower, and you can confirm that yes, the price is holding at this level, and there is something where the price will move. That is, if these elements coincide, then you understand that we have a correction. If there was such a thing, that the structure is broken down, and then this order block was broken and covered all these gaps, you all understand that, well, most likely, something changed. Perhaps you would get a minus here, but you would then be able to re-enter the deal. How to do all this, I will tell you in more detail. But again, getting back to the point, there is this element here all the time. That is, there is a gap here. The price just touches it. Again, this is all on M15. And you are already looking for confirmation on smaller time frames. We will talk about how to apply all this on different time frames. But the point is that smart money elements, like order block, or breaker, or gap, or whatever you use, or inverted gap, should support the idea of upward movement, like some liquidity or downward movement. And if this idea is supported and the smart money blocks withstands this hypothesis, then everything is great. You are moving with the market. If it does not hold, that is, for example, there was a consolidation right here. So you do not know yet what will happen next. But you see a downward structure, that is, the price is falling. Let's say yes. Okay, you, for example, do not trade here. But here you have already realized that, well, there was consolidation there all morning, all London, and then it started to break through. And here you start looking for confirmations here. There is also a gap here. There is a gap here. There is a gap here. There is an order block. And it all gives a certain support to the idea for what? In order for the price to go down, where, for example, this liquidity to take off. Here to cover the gap, that is. And as I said in all my videos, the price moves from the gap to liquidity, or from liquidity to liquidity. That is, these are the basic elements you apply, but look within the framework of what I just showed you.